Welcome to Early Edge Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20 factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
The company that we are analyzing today is Cantabil Retail. So let's look at the business of the company. So Cantabil Retail India Ltd is a prominent name in the Indian apparel market. Cantabil, established in 1989, is an integrated apparel company. This means they handle everything from designing and manufacturing to branding and retailing their apparel and accessories. They cater to men, women, and kids, focusing on the economy to mid-range price segment. You'll find their products across India through their exclusive brand outlets, all under their flagship Cantabil brand. Let's look at what the company offers. They have a strong presence in menswear, which has historically been their core business. They also offer a growing range of women's wear and kids wear. More recently, they have diversified into accessories, expanding their appeal to a broader customer base. Here you can see some of the examples of their designs and various segments they cater to. So I have included samples from their menswear and women's wear collection. But as I mentioned, they also have offerings in kids wear and accessories. In accessories, it mainly includes caps, perfumes, belts, ties. So this ensures a wide selection for families. So I think the company has a larger number of SKUs. Now, what truly sets the company apart from other apparel companies that we have discussed is their integrated business model. Unlike those who might outsource manufacturing, Cantabil has its dedicated facility. This means they control the entire process from design to manufacturing and finally to sales through their stores and online channels. They currently operate one large manufacturing facility spanning 2 lakh square feet in Bahadurgarh, Haryana. This facility is quite impressive with the capacity to produce 15 lakh or 1.5 million pieces of garments annually. This end-to-end control allows for better quality management and efficiency. Now, this has some of the stores. As you can see from the images, the stores aren't typically massive. They are generally smaller, averaging around 1300 square feet. However, the company has been experimenting with larger store formats. They currently have 20 bigger stores and plans to open more in coming years, aiming for an average size of around 1700 square feet for a new outlet. So the company currently operates approximately 600 stores. If I tell you very updated number, then it has reached 607 stores across India. While they boast a pan-India presence, you'll notice from the map that they don't yet have any stores in South India. Their strongest presence is concentrated in North India, particularly in states like UP, Rajasthan, and Maharashtra. Now let's dwell into some of the important business metrics that give us a clear picture of their performance. So in fiscal year 25, the company added 66 new stores, bringing its total count to 600. This expansion will also increase their total retail area to 7.85 lakh square feet, up from 6.64 lakh square feet in FY24. Their sales per revenue square foot stood at around rupees 784. This figure is slightly lower than FY24, which is mainly due to the addition of new and in some cases larger stores that take time to mature. A key metric, same-store sales growth or SSG for the year was around 4%, while their average basket value and average selling price remained relatively stable compared to FY24. The company did achieve a significant volume growth of 5.89%, 15.89%, predominantly driven by these new store additions. Continuing with our metrics, let's break down their store types and revenue contribution. So out of the 600 stores, 250 are exclusively for menswear, 187 combined men's and ladies wear, 116 are family stores offering everything. 41 are exclusive to ladies and kids wear, and 5 are solely for ladies wear. As a brand historically focused on menswear, it still contributes the lion's share, accounting for 81% of the revenue. Ladies wear contributes 11%, accessories 5%, and kids wear the remaining 3%. Geographically, most of the revenue originates from North India. In terms of store ownership, 70% of their revenue comes from company owned and company operated COCO stores, with the remaining 22% from FOFO, basically franchise owned and franchise operated stores. Let's see the industry overview. Since Cat is primarily focused on menswear and plans to maintain this segment, I have highlighted the menswear market only. The branded and organized apparel market in India is projected to grow at a robust compound annual growth rate or CAGR of 18.1% between 20 FY23 and FY27. Similarly, the menswear market itself is expected to grow at a healthy around 17.9% CAGR. This strong growth is fueled by several factors: a rise in Indian middle class with increasing disposable incomes, continued urbanization, and significant growth in e-retail. Within menswear, both formal and casual wear are growing, but casual wear is experiencing higher growth. This trend is driven by evolving corporate dress codes that increasingly accept casual or smart casual attire, alongside growing digital penetration that enhances fashion awareness and trends. Let's see the management. So the leadership at the company is a key asset. The company is chaired by Mr. Vijay Bansal, the founder, chairman, and MD. He brings decades of entrepreneurial and retail expertise, having built the company from the ground up. His son, Mr. Deepak Bansal, serves as the whole-time director. Deepak has been instrumental in driving Cantabil's rapid store expansion and product diversification efforts. Together, their combined leadership has significantly strengthened the company's market share and its to adapt in India's dynamic retail sector. Vijay provides the vision and stability while Deepak spearheads innovation and operation excellence. Apart from them, other independent directors and key managerial persons are also very experienced. Let's finally review the historical performance of the company. The company has demonstrated consistent and impressive revenue growth, achieving a CAGR of 30%. They anticipate maintaining this strong growth trajectory in the future. Furthermore, their profitability metrics, including EBITDA, profit before tax, and profit after tax margins, have not only remained stable but have also shown a positive upward trend. This consistent performance across both top line and bottom line growth is a positive indicator for the business. Now let's start with the key takeaways. So Cantabil Retail currently operates 600 showrooms, and importantly, its same stores growth or SSG stood at approximately 4% for the year. Looking ahead to Vision 2027, the company has set an ambitious target of reaching 1,000 crores in revenue. A significant portion of this, around 8 to 10%, is expected to come from e-commerce channel. Though to achieve this 1,000 crores revenue growth, their SSG will need to be around 5 to 6%. In terms of physical expansion, they plan to increase their total store count to 725 by Vision 2027. New stores are anticipated to be larger, averaging around 1,700 square feet, an increase from current average of 1,300 square feet. Currently, menswear remains their primary revenue driver, accounting for 81% of sales, and their sales per square foot are 785. Now let's explore the bull case. Firstly, the company has an aggressive store expansion strategy, aiming for 725 stores by FY27, coupled with a clear, ambitious 1,000 crore revenue target for the same period. This expansion, alongside an increase in average store size, signals a strong push for market penetration and top line growth. Secondly, management is confident about profitability with an expectation that EBITDA margin could reach 28% to 30% in the coming years. This suggests a focus on operational efficiencies and optimized pricing. Thirdly, Cantabil is diversifying its growth avenues. They project e-commerce to contribute significantly to their future revenue, and they anticipate an increase in the ladies' wear component of their sales. Lastly, the company demonstrates sound financial management, projecting a healthy free cash flow of rupees 60 crores post rent and capex. They also have a long-term target for efficient inventory management, aiming for 110 to 120 days of inventory. And lastly, they have recently partnered with Zepto for their products to be available on for quick commerce on the Zepto platform. So that is another positive one for the company. Now the bear case. So one key concern is the pressure on same store sales growth. While the target for FY27 is 5 to 6%, their SSG for the year stood at approximately 4%. And in previous quarters, it has been in single digits. If they cannot consistently achieve their targeted SSG, the ambitious revenue target may be challenging to meet, especially since current volume growth is largely attributed to new store additions. This brings us to the second point, the heavy reliance on new store additions for volume growth. If there's a slowdown in new store openings due to market saturation, increased competition, or rising real estate costs, overall revenue growth would be significantly impacted. Thirdly, while demand in Q3 showed improvement, Q1 and Q2 experienced sluggish demand. A prolonged period of weak consumer demand could negatively affect sales across all their outlets. Finally, the company has explicitly stated that lower EBITDA margins are due to pressure on SLG. If SLG continues to face challenges, achieving the projected EBITDA margin improvement of 20 to 30% might become difficult, impacting overall profitability. Now let's see it through our framework. So IPL fundraise. So the company has been listed a long time back, but recently they did a preferential allotment to one investor only. I think it was Thinking Partners LLP. They have raised 50 crores. And the reason why I gave a 315 score is mostly it is not clear how much amount they have allocated for certain things. But in general, I have found that they are planning to use the amount for payment of borrowings, working capital, and to meet future capex requirement. Direct and promoter track record is very good. They only hold majority of the stake of the company, and there is no bad track record about them. So I gave a 5 and 5 score. Related party transaction. So there was purchase of fabric from a company which is related, which is in which our directors have some interest. So because the amount were a bit big, 23 crores and 29 crores. So that is why I gave 315 score. Board composition, it is professionally managed board. Only two people are on board, a family on board. So I gave a 5 and 5 score. Remuneration has also been in our limits. So I gave a 5 and 5 score there also. Key person resignation. So no one has resigned recently or in a long time. So I gave a 5 and 5 score. Auditor resignation. So auditor resignation was there, but the reason why I gave 5 and 5 score was the auditor had resigned because there was an issue because they were demanding higher fees and the company did not want to pay higher fees. So that is why they had resigned. So I found it not something which should concern us. So I gave a 5 and 5 score here. Auditor opinion has been unmodified and credit opinion has also been upgraded. So I gave a 5 and 5 score there also. There were no regulatory or legal issues found. So I gave 5 and 5 score. Investor communication has been there, PPTs, phone calls, etc. So I gave a 5 and 5 score. Now section 2. So there is no business concentration there. So 5 and 5 score. Cash flow by EBITDA has been good, but it is just a bit below what we consider a 5 and 5. So that is why I gave a 3 and 5 score. Receivables versus revenue versus receivables has also been good, but the reason why I gave a 3 and 5 score is because in FY23 and FY24 it went up a lot and it has come down. We'll have to see how it performs in the coming time also. So that is why I gave a 3 and 5 score because it has been very fluctuating in nature. Inventory trends, the reason why I gave 0 and 5 was it is the inventory days are very high. So that is why I gave a 0 and 5 score. Cash conversion cycle has also been on a higher side, but I think for a retail business, it is comparable. So I gave a 3 and 5 score here. Capex by revenue has been good. So I gave a 5 and 5 score. So debt, as per our metrics, it is a bit high. Interest coverage ratio is fine, but debt to equity is a bit high. I think they have 400 crores of debt. So I gave a 3 and 5 score. Quick ratio is not that good. The current ratio is fine. So I gave a 3 and 5 score there also. ROC and ROE has been consistent and it has been consistently good. So I gave a 5 and 5 score. Same goes for revenue growth. revenue growth, EBITDA margins, PAT margins, everything. The margins have been great, and the revenue is also growing at a good pace. So I gave a 5 and 5 score. After all this, the overall score comes out to be 81. So it's a good company. And for the valuation and final take, I'll hand it over to you.
So let us quickly run into the valuation. One thing, can you clarify? So they are at the PE of 30 at the current price, 266 is the current price. Yes, they have done relatively well for a small company. They have grown at a very consistent phase. That's really heartening to see, and they are projecting to grow at 30% and hope they achieve the 1000 target revenue. But anyway, considering the management's guidance, let's take the worst case, which is approximately between 25 to 30%, which is 839. And it's really, they have also improved the operating margin. So I would go take the last 5 years operating margins for our analysis and give at least a 27%. And yeah, PE of 30. So the price targets comes to 311. It's trading at 226. So if you take 1 year forward outlook, then there is still some room for upside based on if the PE is maintained and the management is able to grow at guided 30%. If you are having a longer time frame, at least of 5 years, and so the free cash flow here is 101, which is really good. So let's just take the free cash flow, and if our required rate of return is 20 and the terminal growth rate is 3 and our holding period is 5, and yeah, let's just give the multiple as 16, then the implied growth rate is 20%, but the management is guiding for a 30% growth rate. So that is also after considering free cash flow. So this is a very, there is a good margin of safety in the current price if you extend your holding period. Also, the company has consolidated for the last 3 years. So these are a few interesting facts. So SSG is also positive. We had analyzed few other retailers. The SSG has been negative. SSG being positive is another good sign. I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching, and we will see you in the next one. Bye-bye.